It seems like everybody is talking about this one thing and how it's going to have a big impact on the overall crypto economic outlook or crypto economy or crypto marketplace. And I don't think most people understand what it is. And this term's been thrown around. And there's 6 pretty major events happening this week that will have a major impact on the thing that I'm speaking of. And I'm talking about everyone seems to be talking about quantitative easing, when it's going to start, when they're going to end quantitative tightening. And this week will be a very, very impactful week for looking to see if they're going to end quantitative easing and end quantitative tightening and start quantitative easing, or if they're going to stay on their current path, which is quantitative tightening. Now, this has nothing to do with the FOMC interest rates. I mean, it does have something to do, but it's different. This is not necessarily lowering of the interest rates. It's other things. We're going to get into that. And first, we're going to take a look at where are we right now in the marketplace? And so when I look at Bitcoin right now, I can tell you that it looks, and this is not financial advice. I'm certainly not your financial advisor. Do your own research. I'm just sharing with you some of the things that I look at and impacts me. And if you have any comments, questions, put them down below. If you're not a subscriber, now's the perfect time to hit the subscribe button. And if you find any value whatsoever, or if you just feel bad for me, hit the like button. I greatly appreciate it. All right, so if you take a look at the Bitcoin price, this blue line right here represents a floor of support that, once we busted above this line, look at it. We bounced off it a couple times. We broke through it one time, but quickly broke back above it. And then we've bounced above it. But I'm looking at maybe a new line here. And if we can stay, maybe this is the transition and the flip where we start to see Bitcoin rise. But it's going to take a pretty decent week for that to happen. Just before we get into the 6 events I'm talking about, here's the day. Looks like a lot of things are up today. And the week, we have some actually things up on the week. Ondo, Litecoin, Shiba, Mantra, a couple decent moves. But I'm looking for the big players. And there's still, Solana, 2%, 3%. So all in all, the market's just waiting for news. All right. There needs to be, for the market to really pump up, we need to have more money in the market. And what's going to push that forward? And then I look at this week's economic calendar. It is stacked full of data. It's going to be a very volatile week depending on the outcome of these things. So you look at February 11th, nothing so much on Monday. But February 11th, they have a bunch of the Fed presidents. They have different offices, and each office has a head. And the overall head is Jerome Powell, who speaks on, I believe, Wednesday. He testifies in front of Congress. Now, the things he says, people will be hanging on his every single word. And the things he says will potentially change the outlooks, right? If he says things are this way, people are going to plan accordingly. And if he says things are over here, people are going to plan accordingly. He probably will be very careful about what he says as to not move markets. All right, the other thing that's happening on Wednesday that's extraordinarily important is consumer price index. Now, I'm going to tell you about quantitative easing to better understand why these things matter. And quantitative easing means, well, let's go back in history. In 2008, when we had a mortgage meltdown, the Fed dropped their rate to zero, right? The borrowing rates down very, very low. They did this again right after the pandemic. And that in and of itself makes money less expensive to borrow. It creates liquidity in the marketplace. It means that people that, instead of putting your money in bank to get a 4 or 5% return, you had to go seek other places to get a return if you had money back then. So people would look for higher risk assets to get a return on their money so their money doesn't deflate at the current rates, whatever they be. And so quantitative easing started happening also. They're like, okay, this isn't just enough to lower the rates. We have to inject the marketplace with even more capital. So what they did was they started buying treasuries, which are, basically bonds, government bonds, and they started buying mortgage-backed securities, which helped lower the long-term mortgage rates. And this created a lot of liquidity in the marketplace. If people had lower car payments, lower credit card rates, and lower mortgage rates, it would give them more money in their pocket to buy other goods and services, which lifted the economy up. That's the theory. That's how it typically works. It also creates inflation. We know this. But the the quantitative tightening was the opposite. Back a couple years ago, to stem inflation, they had this huge book, the Fed had this huge book of mortgage-backed securities and treasuries. Now they started selling. They're flooding the market with their treasuries. And what's that do? If you're selling a bond, the price of the bond goes down. God, I'm all in reverse today. If you're selling a bond, if I sell you a bond and I'm desperate to get rid of it, I'm going to require a lower price. You're going to pay a lower price for it, which increases the actual yield that you get on it. Now, I can go into deep detail on how that works. It's an inverse relationship between price and yield. Yield is the interest rate. In other words, if I sell you a $100 bond, okay, with a face value of a 4% return, that means you get $4 annually for holding that bond. If you paid $90 for that bond, but still get $4 back, you're going to get a higher rate of return. That's how the inverse relationship works. So when you're quantitative tightening, you're selling all your assets on their books, and they have trillions of dollars of assets on their books. Trillions. And so they've been selling these things off the last couple of years. They flooded the market and kept the rates, I will call it artificially or purposefully high, in order to stem inflation and stem liquidity and keep hold of these things. Now, quantitative easing is the opposite of that, and that's what we're hoping for. And in order to have quantitative easing, you have to be able to show that the economy might not be doing so hot, that inflation is in check, and you're more worried about the economy failing than you are about inflation being high. So you're going to flood the market with liquidity. And in order to see that, these economic factors have to be significantly changed for us to do that, or I should say the Fed to do that. So consumer price index is basically looking at a cost of a basket of goods, and is it going up, down, or is it going up at a slower rate? So the inflation might not actually be going down. It might just be going up at a slower rate. So this is what it's forecasted, 0.3. This is what it was last time around, 0.4. So that's moving inflation in the right direction. And if you look, 3.3, where's my calculator? 0.3, so 0.3 times 12 is 3.6%. So they're saying that consumer price index has an inflation rate of about 3.6%, well above the target, but slowing down, which would be good. CPI year over year, then it's actually slowing down even more. So these would be good indicators for the Fed to say, okay, that looks good. Next up, that's the second thing. The first thing was Fed Chair Powell. God, that's hard to say. Speaking in front of Congress. Hopefully that goes well. That's number two. Number one, CPI. Number two is Powell testifying. Number three, initial jobless claims. This is bad, but more unemployment is good for crypto. How? Because that shows the economy is slowing down. Now, I'm not saying I like to see people unemployed. It's going to happen whether I like it or not. People are going to be employed or unemployed. But it's a major look. So that's the third thing. If that employment rate comes out or jobless claims comes out higher than expected, in other words, there's more jobless claims, that's going to be good for having the Fed say, okay, there's another indicator. We should probably slow down our quantitative tightening and start to switch to quantitative easing. The fourth thing, producer price index. That's the cost of goods and services to be produced to sell. It's a leading indicator of what the CPI might do in the future because you're looking at the cost to produce those items. And from a manufacturing and a goods delivery and things like that service standpoint. So it looks like it's going to come in a little worse than it did last time, which means that might be increasing, which could be due to tariffs and things like that. So that's the fourth thing. The two more things, import price index. What's it cost to import things? Well, we know with tariffs, we should probably see, and they're predicting this to go up, even though the tariffs really hadn't taken hold yet. So we'll keep an eye on this as well. And finally, retail sales. That's really the mindset of the consumer. And if they feel really comfortable with where we are economically, they're going to spend more. And if they don't feel, think about yourself. If you feel good about where your income is and where the economy is going, you're more apt to spend money than if you're not real comfortable with the way that things are going. So this U.S. retail sales is predicted to be significantly less than it was in the previous one. And if it does hold true to this, then that would make the Fed feel better about moving towards quantitative easing versus tightening. So all in all, we have six major events this week to take a look at. And if they bode well for economy slowing down or inflation slowing down, jobless reports, more jobless claims, then it's very possible the Fed might switch their stance or start to ease up on quantitative tightening. and switch towards quantitative easing, which would put more liquidity in the marketplace and, make it more money out there for people to buy and invest in crypto, and make it more for people to push people to go towards more risk on assets, things more risky than holding your money in cash. And so when inflation rate is very high, but cash actually depreciates at a faster rate than other places you can put your money, but it's a lot less risky. Remember, this is not financial advice. I'm certainly not telling you what to do. Do your own research. Let me know what you think about this and what you might possibly do. And if you found any value in this whatsoever, do me a favor and smash that like button. I will see you next time.